before we delve into your numbers, they're a day old boring. Let's look at volatility, because that's the story of the day. The swings, the gyrations that we saw in the markets. How good is it for your business?
Well, we're a trading and investing business, so whether it's a buy or a sell, it's a trade. So days like this, we'll probably do, I don't know, 1 million trades or thereabouts. And if you contrast that with a couple of years ago, TD Ameritrade, pre our Scottrade deal, would do about 500,000. So a double, pretty nice.
Is there like a sweet spot where you want to see volatility? And obviously that causes people to churn and trade. That's great. But you don't want people to lose a bunch of money.
No, of course.
Because then, right, eventually people get dispirited and they just sort of walk away. So what is sort of the volatility sweet spot for you, where people are still doing well, they still like to be engaged, but there's enough action that they want to make moves?
It's not a number so much as it is a duration of the level of volatility. I mean, we've seen, as you guys know better than most, vols hitting these sort of secular lows when the long-term range is sort of more like the 20. So you see a spike up like we saw in February, you see an enormous amount of activity. You see the spikes of the last few days. Those are all very good for certainly active traders because they see opportunities, right? Our clients tend to be a little bit opportunistic. They saw the opportunities today, some of the announcements in the earnings that they were actively trading, because that doesn't seem to make a whole lot of sense. If it continues for a number of days, great. If it's, and you mentioned the headline of the article I talked about, it feels like it's a bit of a frothy top. On the other hand, if you have a secular decline, a more sustained bear market, then some people, not so much the active traders, but some people will just say, you know what, time to go to the sidelines, we'll move to cash, and we'll wait it out.
When we looked at some of the broader market data, it seemed to suggest that a lot of retail investors weren't actually moving around amid some of these sell-offs. And I wonder, when you look at your business and particularly some of the cash you have in your accounts, are you seeing more activity now than maybe what we did, say, earlier this year?
Well, certainly if you look at the longer-term trend of cash in an account relative to the bull market, in fact, I was looking at the data today, literally if you go back 10 years, the percentage of cash clients would have in their account overall at TD Ameritrade used to be at 21%, and we've had, of course, a 10-year bull market, and now it's 11. So it's literally been, almost the same sort of decline. Now, if you get the reversal, to my point earlier, you will certainly see cash going back into the accounts. It's also good for us. Rising interest rates, we have cash on deposit. That's another revenue for us.
One of the interesting things about the market lately is we have seen enthusiasm about individual stocks and trading individual stocks in pockets of the market really pick up. So cannabis was obviously one where people got excited about trading individual stocks in a way that you hadn't seen, I think, in a long time in this market. Do you see that as being a sort of sustainable theme for us for a while? People maybe getting bored of being told to index and just buy the same amount of SPY and TLT every month?
I don't know if it's boredom as much as it is people like to trade what they know.
Yeah.
That doesn't say anything much for cannabis stocks, but crypto, for example, in the fourth quarter was clearly driving a lot of intensity.
Right.
Cannabis, for example, we just talked about it. In the last quarter, that was about 6% of our trades, but crypto this past quarter were about 1% of our trades. So it's just the bloom has come off that rose. Next quarter, it'll be a different story. Your point about passive by ETFs, by sectors, I don't know if that's a boredom issue as much. I think it'd be interesting to see what happens when you don't have just this sort of perennial sustainable market run up, whether active gets a little bit more attractive to people as opposed to just buying and holding the passive, when there's actually not just everybody, not all boats are floating on the tide.
Right.
Tim, you talked about how rising rate environment helps you. You sit on a lot of cash, was 140 billion, you can put that to work. What about your clients, therefore, being able to put their own cash to work in other areas of the market? Does that ever become are they just going to, could they ever take it out of TD Ameritrade and go and park it in a bank because finally they're getting some yield?
Absolutely. Well, the way to think of it is probably roughly speaking, two sectors. There's the interest rate sensitive clients, and as interest rates start to rise, of course, they get more interested in getting the maximum yield for their money. The vast majority of our clients, however, are looking to use cash, and that's their dry powder that they're going to deploy into the market when they see opportunities.
One thing, though, when you talk, I just want to talk quickly about commissions and brokerage commissions specifically, because we've seen sort of this race to the bottom with a lot of other brokerages, and I'm wondering how that's affecting your business and how you adjust to an environment where you have a certain group of investors who are expecting free commissions or at least rock bottom.
Right. Well, I'd say look at the longer term trends. both TD Ameritrade as well as our closest competitors were born out of a massive disruption in pricing, 1975, right? Back then, just to do one trade of 100 IBM shares would have cost you many hundreds of dollars. The price point then would drop to, call it 50, and here we are 90% lower than that, 20 years later, or rather since 1975, so 45 plus. Now we're at the levels where price is not that much of a barrier for clients in terms of trading activity. Another way to think of it is there's been this sort of secular, last 20 years alone, about 9% compound annual decline in the price of a trade. And yet in our particular case, our revenues from trading have gone up about 3%. So in other words, trade levels have gone up 12% over that period of time. So we see that as, yes, continued inexorable pressure. The retail client wins, more competition, more price competition is great, which is driving consolidation in the industry to some degree, and scale wins.